Well, hey everyone, and welcome. Let's dive right into this explainer on what is frankly a fascinating global market paradox. Right now, we are watching this massive, almost unprecedented tug of war. On one end of the rope, unstoppable tech momentum, and on the other, some really profound, deep-seated macro fragility. If you've been looking at the markets lately and feeling a bit of whiplash, between these staggering record highs and very real economic anxiety, well, you're in exactly the right place. We're going to break down exactly what's causing this great divergence.
We've got a lot of ground to cover today across a bunch of different disciplines, so here's our roadmap. We'll start with 1. The AI macro paradox, then 2. The $1 trillion engine, 3. The hardware and space frontier, 4. Physical and social bottlenecks, 5. Solving the bond riddle, and finally 6. The bull versus bear debate. So let's jump right in.
Section 1. The AI macro paradox.
Okay, we have to start by looking at this incredible tension between tech indices breaking records and the genuine anxiety out there in the broader economy. The juxtaposition here is just wild. We've got the S&P and NASDAQ closing at absolute all-time records. You've got individual companies, like Micron, adding a whopping $163 billion in market cap in a single day. I mean, to put that into perspective, that's like adding the entire market value of Charles Schwab overnight. But then, look at the flip side. Everyday consumer confidence is slipping down to 93.1. We're looking at unsettled geopolitics, strikes in Iran, rising threats in the Baltic. It literally feels like two completely different realities are trying to coexist right now.
And honestly, that's the core of our paradox right there. Imagine the global economy as a giant seesaw. Sitting on one side, weighing it down, is this incredibly powerful $1 trillion AI infrastructure engine. And it's acting as a counterweight against the sheer friction piling up on the other side. We're talking $4.50 gas prices, squeezing regular consumers, escalating global conflicts, and even sudden corporate shakeups like the recent ousting of BP's chairman. Somehow, this relentless AI momentum is just single-handedly powering the indexes right past all of those collective anxieties.
But, there's a warning light flashing right on the dashboard here. If you look at the gap between the S&P 500's earnings yield and the 10-year Treasury note, which is what we call the equity risk premium, it has basically zeroed out. We are heading straight into a valuation danger zone. Statistically speaking, equities look just as unattractive right now as they did right before the dot-com bubble burst. And yet, investors are completely brushing off that relative yield reward, and they're just piling into stocks at a totally feverish pace anyway.
Section 2. The $1 trillion engine. So what exactly is fueling this upward force? How is it completely ignoring those flashing warning lights? Well, let's unpack the engine behind it. The really crucial point here is that we are in the middle of a massive evolutionary leap. We're moving away from phase 1, which was basically just us manually typing prompts into internet chatbots, right? And we are entering phase 2, agentic AI. These are autonomous agents that can actually execute complex, multi-step workflows without any human intervention. But here's the catch, and it's a huge multiplier effect. Moving to this agentic AI requires a staggering 100 times more computing power. To sustain that kind of scale, the industry suddenly needs over $1 trillion in annual infrastructure spending. To really understand where that $1 trillion is going, let's look at the hardware hierarchy. Tier 1 is your core compute, the actual GPUs. As the tech saying goes, if compute is the chef, then high-bandwidth memory, which is our Tier 2, is the cutting board. NVIDIA is pouring $150 billion a year into expanding compute, while Micron just hit a $1 trillion market cap simply because we are quite literally running out of cutting boards. And then down in Tier 3, you have optical networking companies like Ciena and Lumentum. They're using silicon photonics to move data with light instead of copper wires. Why? Because they literally need to stop these massive, overworked data centers from overheating and catching on fire. It's wild.
Section 3. The hardware and space frontier.
Because of this immense processing build-out, we're being forced to look way beyond our traditional boundaries. Look, Earth fundamentally lacks the physical land and the energy capacity for this 100x scaling. So the market is aggressively funding the ultimate frontiers, space and quantum. For orbital infrastructure, the market is currently eyeing a potential $2 trillion IPO for SpaceX, because sending compute and networking into orbit is actually the next logical play here. And on the processing side, we're seeing massive bets on quantum computing, like the Honeywell-backed Quantinium, which is targeting a $12.7 billion valuation. The demand for infrastructure is just vastly outgrowing traditional terrestrial capabilities.
Section 4. Physical and social bottlenecks.
However, that massive upward momentum is slamming headfirst into physical reality and societal resistance. If you look at the pressure dials for energy, land, societal backlash, and moral warnings, they are all redlining. They show the real friction we're facing as these massive power and land requirements hit hard limits. Finding the power grid capacity to run these AI campuses is becoming nearly impossible in some areas. It's even leading to major pivots, like Compass Data Centers having to completely withdraw a massive 800-acre mega project in Virginia just recently due to overwhelming local resistance.
And impartially speaking, this friction isn't just about logistics and power lines, it's deeply societal and moral. Right now, 14 different U.S. states are actively debating strict building moratoriums on new data centers. It's turning into a massive political battle. And taking it to a global moral scale, Pope Leo XIV recently issued an encyclical directly warning against the potential harms of AI. He cited the massive carbon emissions, the severe water drain required for cooling these centers, supply chain impacts, and even the philosophical risk of reducing human beings down to mere data points. So the pushback against this trillion-dollar engine is very real, and it's coming from all sides.
Section 5. Solving the bond riddle. Given all of this physical, social, and geopolitical friction, we really have to ask, how is the broader global macroeconomy reacting? Well, we're seeing what city analysts are calling a wait-and-see resilience shield. We have active shocks happening all over the globe right now. Unpredictable defense moves in Europe, economic turmoil unraveling in Cuba, missile strikes in the Middle East. Normally, this level of macro fragility would absolutely tank the markets. But surprisingly, the global economy is absorbing these shocks incredibly smoothly. The market is basically wearing a thick, heavily insulated armor of AI optimism.
And that brings us to the bond riddle diagnostic matrix, which really helps explain why the bond market is behaving so strangely. We've seen 10- and 30-year Treasury yields steadily rising. But why? Well, if it was just soaring inflation or a loss of trust in the Fed, the yield curve would look entirely different than it does right now. If it was just insane government borrowing, investors would be super hesitant about long-term lending, and we're not really seeing that either. So the verdict? The most likely reason long-term yields are rising is actual AI reflation. The market essentially believes that AI is structurally creating a stronger, higher-rate economy across the board.
Section 6. The bull versus bear debate.
Let's tie all these complex threads together into the ultimate debate that is absolutely dividing Wall Street right now. This is the great divergence in a nutshell. The bulls believe that AI has fundamentally broken the old boom and bust cycle. Their argument is that things like memory chips aren't just cyclical commodities anymore. They are locked-in, permanent infrastructure that's going to permanently elevate economic growth. But the bears? They warn that history tells a very different story. They argue that narrow, extremely fast, privately funded capital booms of this magnitude always, eventually, require hard proof of durable earnings. The initial excitement absolutely has to translate into broad corporate profits, or the bubble eventually pops.
Which brings us to a really timeless reminder from the legendary investor John Templeton. He famously warned that the 4 most dangerous words in investing are, this time it's different. It's a stark reminder for all of us tracking this to remain fiercely objective. When market euphoria starts overtaking historical cycles, we really have to anchor ourselves to the data, not just the hype.
So to see which side of this debate might actually win out, you're going to want to keep your eyes on the Costco bellwether. The divergence here is fascinating. The broad consumer mood is trending downward, mostly because inflation is really dampening spending. And yet, Costco's shares are up 15% year-to-date. Because they cater to a slightly higher income demographic, their upcoming earnings report is going to serve as the definitive verdict on whether middle to upper class consumers can actually sustain the discretionary spending needed to keep this overarching economy afloat while the great AI build-out continues. So I'll leave you with this final provocative thought to chew on. Can a $1 trillion technology engine truly and permanently rewrite the rules of global economics? Can it outpace hard energy limits, growing societal pushback, and tapped-out consumers? Or is this giant seesaw destined to inevitably snap back? Thank you so much for joining me on this explainer. Keep analyzing, keep questioning, and I'll see you in the next one.